Welcome to this video on One Up on Wall Street by Peter Lynch. In this video, we'll explore the key takeaways from this investment classic and understand how it can help you become a better investor. Peter Lynch is a legendary investor who managed the Fidelity Magellan Fund from 1977 to 1990. During his tenure, he delivered an annualized return of 29.2%, making him one of the most successful fund managers of all time. Peter Lynch wrote One Up on Wall Street to share his investment philosophy and approach with individual investors. He believed that ordinary investors can beat the market if they invest in companies they understand and have confidence in. Most people have the necessary intelligence and interest to do well in the stock market. You don't need a high IQ or a fancy degree to be a successful investor. You just need to follow some basic principles. One of the key principles of Peter Lynch's investment philosophy is to invest in what you know. He believed that individual investors have an edge over professional investors because they have more exposure to everyday consumer experiences. The best investment opportunities are often right in front of you. Look around you. What products are popular? What stores are busy? These are all clues to potential investment opportunities. For example, Peter Lynch noticed the growing popularity of fast food restaurants in the 1970s and invested in companies like McDonald's and Taco Bell, which turned out to be huge winners. Peter Lynch believed that successful investing requires patience and discipline. He cautioned against making impulsive decisions based on short-term market movements. Investing is not a get-rich-quick scheme. It's a long-term game that requires discipline and patience. You need to have the confidence to stick with your investments, even when they go through temporary setbacks. Peter Lynch believed that individual investors should do their own research and not rely solely on the opinions of Wall Street analysts. You need to be your own analyst. Do your own research, read financial reports, and understand the company's business model and competitive advantage. Don't rely on tips from others or blindly follow the herd. Peter Lynch was a contrarian investor who looked for undervalued and underrated companies. Peter Lynch believed that the best investment opportunities often lie in overlooked and underappreciated companies. These companies may have strong fundamentals and growth potential, but are not yet on the radar of Wall Street analysts and institutional investors. Underrated companies can be found in small towns and industries that are not glamorous. These companies may have unique products or services, loyal customers, and strong financials. For example, Lynch invested in Hanes, a company that produced underwear and socks, which was not a sexy industry but had strong brand recognition and a loyal customer base. He also invested in a small pharmaceutical company, named Alza, which was developing a drug delivery system that was not yet approved by the FDA. But Lynch saw the potential in the technology and invested early, which turned out to be a huge winner. Peter Lynch believed in being a contrarian investor. This means going against the crowd and investing in companies that are out of favor with the market. If everyone is bullish on a stock, it's probably too late to invest. But if everyone is bearish and the stock is cheap, it could be a great opportunity. For example, during the market crash of 1987, Lynch saw an opportunity in the panic selling and bought stocks at bargain prices. He recognized that the market was overreacting to the news and that the underlying fundamentals of the companies were still strong. Peter Lynch believed in diversifying your investment portfolio. This means investing in a variety of companies across different industries and sectors. Diversification is the key to reducing risk and maximizing returns. You don't want to put all your eggs in one basket. Lynch also recommended investing in different types of stocks, such as growth stocks, value stocks, and income stocks, to further diversify your portfolio. Peter Lynch believed in staying humble and continuing to learn about the markets and investing. The market is constantly changing, and you need to adapt and evolve your investing strategy. No one has all the answers, and you can always learn from others. Lynch recommended attending investment seminars, reading financial books, and following the news to stay informed and up-to-date on the markets. In conclusion, One Up on Wall Street by Peter Lynch is a timeless investment classic that provides valuable insights and principles for individual investors. By investing in what you believe in, looking for underrated companies, being a contrarian, diversifying your portfolio, and continuing to learn, you can improve your chances of achieving investment success. Remember, investing is not a one-time event, but a lifelong journey. It requires patience, discipline, and a long-term perspective. But if you follow these principles and stay focused on your goals, you can achieve financial freedom and security. If you want to learn more about Peter Lynch's investment philosophy and strategies, be sure to check out his book One Up on Wall Street. It's a must-read for any individual investor. Thank you for watching this video on One Up on Wall Street by Peter Lynch. We hope you found it informative and useful. Remember, investing is not a sprint, but a marathon. Stay focused, stay disciplined, and stay invested. So if you're ready to take control of your financial future and start investing in yourself, hit that subscribe button and let's get started. I'm excited to be on this journey with you.